I've been trying to get this into our program for over a year. I haven't found the right person to be on stage and explain it, and I think we finally have.
I hope so.
So maybe we start, I don't think most people appreciate how climate has affected the insurance industry, and then how the insurance industry is affecting real people and making life really difficult. So maybe could you just set our expectations? What is the scale of the problem? How did we get here? And how's it affecting people?
Yeah, absolutely. So as the planet continues to warm, we're seeing increases in the frequency and severity of a range of weather-related perils. And as that risk grows, insurers are paying out more and more in claims. And it's becoming more difficult for them to profitably offer insurance coverage against these types of disasters. And so as they have to pay more claims, they have to raise their prices. And as they have to raise their prices, then people feel it hitting their pocketbooks pretty profoundly in some parts of the country. Recently, in the past couple of years, we've seen that the growing risk of disasters has been coupled to also increasing costs in rebuilding from COVID-era supply chain and labor market disruptions and our prior period of high inflation. And all of that has really created this perfect storm where we're seeing rates increase dramatically around the country. And in some of the areas at highest risk for climate-related disasters, insurers are even exiting markets altogether. And that's starting to have spillover impacts, not just for people's pocketbooks, but for housing and mortgage markets. You can't take out a loan to buy a home without an insurance policy, and local economies when they try to recover. And the last thing I'd like to highlight is that it's not just the big events like hurricanes and catastrophic wildfires that are stressing the industry, but it's all the smaller scale events too. Just bad thunderstorms and hail are increasing everywhere in the country, and they're paying out more and more for those types of losses as well.
So when I first heard this story, it made a lot of sense to me. It was like, oh, insurance companies don't want to insure beachfront property in Florida because there's no way to do that in a cost-effective way. I thought it was their problem, not a my problem, living in upstate New York. But it really is. It's grown beyond Florida.
Oh yeah, we're seeing price increases around the entire country right now. And places where the market's really starting to get stressed are also growing beyond Florida to other areas of the Gulf Coast. Louisiana and Texas come to mind. California has been struggling with their wildfire coverage, as has Colorado and other places. So it's really, yeah, it's growing.
So when the private insurance industry leaves a state, and a lot have left Florida, what is left? Like, what's the backup?
Yeah, so what happens when the private sector withdraws is the government usually steps in order to protect our housing markets and people's recoveries. So, for example, decades ago, insurers stopped offering flood coverage because of the problem with how costly it is to cover flood damage. And so we have a federal program that provides in excess of 90 or 95% of all residential flood insurance nationwide. But what we're seeing is that as climate is stressing some of these other perils, like hurricanes and wildfires, all the states that have a high degree of risk from those types of disasters have their own state-level insurance programs. And so these are unique to each state, but every state prone to hurricanes across the Gulf and Southeast has one for homeowners who can't find insurance property coverage in the private market, and California has one that's been writing a lot of wildfire. Colorado just had to create one for the first time because of challenges in their market. So we see this migration of risk from the private sector into these public sector programs.
And how does that affect the burden of responsibility for homeowners to deciding where to build, how to weatherproof their homes? Like, if the government's going to pick up the check at the end of the day, like, doesn't it create strange disincentives?
Yeah, this is a really live policy debate right now, is what role these public sector programs should play in the market. And so a lot of them were created to be what's often called markets of last resort. And so they were only there for people who really couldn't find coverage in the private market, and they didn't want to compete with the private market. And because of that, they tend to charge more and also tend to offer less robust coverage. But now what we're seeing, as so many communities are kind of having prices that are just so high or complete lack of availability, some of these state programs are getting pressured to lower rates themselves and actually provide coverage at a lower cost. And on the one hand, it's really important that people have access to insurance. We know from our research that it is very difficult to recover at all without insurance. We just don't have other good sources. while we spend a lot in disaster aid, actually very little gets to households for what they need to get back on their feet right after a disaster. So insurance is really critical, but on the other hand, if you make it cheap or available in places that are really too risky, are you creating incentives for us to keep building in places that are really not safe and too costly to keep building? And so there's a tension there that's playing out differently in different states.
How is it playing out in a place like Florida, where there is still the waterfront, even though everybody knows it's got a expiration date, they're still building, and the buildings are getting even bigger. How is that working in Florida right now?
Yeah, Florida is a very challenging case, and they've actually been dealing with this problem going back, I'd say, to at least 1992 with Hurricane Andrew, which really started to kind of destabilize property insurance markets in Florida. And they've kind of had this up and down over the decades since then of whether they want their state program to be providing cheap, widespread insurance, which they see as kind of fueling the housing market and development, or when that gets to be too problematic, meaning they have a lot of exposure and they're worried about kind of the programs going bankrupt if there's a big event, they've tightened back down and tried to kick people out of the program and raise rates. So they've kind of gone back and forth between market of last resort and market of first resort. And what we see right now is that the state has essentially 3 public sector programs. They have the insurance program, which unlike any other state is the largest writer of insurance in Florida because most big carriers have left. The ones that are left tend to be small regional companies, and most people have to go to the state program. But they also are the only state with their own reinsurance program, and like many other states, they also have a program to pay the claims of bankrupt insurers, which they've been doing some of because some of those smaller companies have gone bankrupt after the bad hurricanes that the state has seen recently. So I'm getting to your question. Yeah, so, but all 3 of those programs are actually not taking in enough money up front to cover those losses. And they're designed to pay out after a big event using debt. So if a big storm hits Miami or many hurricanes hit in one year and they have to pay a lot of claims, they go to the bond market, they take on debt and then to pay the claims, and then they pay it back by assessing future policyholders. First, just those in the state program, so it's future policyholders that will pay the cost of the event. And then if the event's really big and that's not enough money, they have, all 3 programs can assess essentially every property insurance policy in the state. So you could be in North Central Florida and have a car insurance policy, and you will be assessed with fees on your insurance to pay the claims of the big hurricane that hits Miami. So there's a lot of cross-subsidization from low risk to high risk.
And ultimately, if I'm following the money correctly, like this is a fairly regressive tax on people across the board. Like it's the taxpayers are going to wind up picking up all these bills.
Yeah, residents throughout the state are going to be paying the cost, yes.
And yet it's so abstract and sort of convoluted that they're not really going to understand that.
I'm not sure how well it's known, how much people appreciate that they are at risk of facing much higher rates because of this structure of these programs in a state that already has the highest insurance costs in the country.
And it also, the thing that concerns me is like that when I got my house insured with a new insurer, I got an inspection, they came to the house, they said, you know what, you can't have these trees so close to your house. It's too much risk, it could come down, it could hurt the house, and we don't want to insure you unless you get those branches taken down. It seems to me that that's a reasonable response for an insurance company to sort of mitigate their risk. If you take that process out, it seems things get out of hand pretty quickly.
Yeah, I mean, there's only a small amount you can do with kind of financial engineering to make insurance cheaper. If you want insurance to cost less, you have to reduce the risk, right? The cost of insurance is very much related to the risk. And so if we want to kind of get a handle on rising insurance costs, we have to be investing in those types of changes that make properties safer. And as insurance companies are facing rising costs, they're realizing how important that is through things like required inspections and so on. But it can sometimes catch policyholders off guard when they haven't had to do that or think about it before. And sometimes the changes that need to be made to a structure to make it safer are not cheap, and folks might not have the money to pay it up front, so it's causing some problems.
What's the solution here? Well, obviously, you'll hear the theme throughout the day. It's like, are there policy changes that need to happen? And what would work in a situation that's complex?
Yeah, I think we need to be having more conversations between the insurance sector and the public sector that's making decisions about building and land use. Because we need to be making sure that the investments we're making in helping communities become more resilient and safer are also translating into what the insurance sector needs to write more coverage and write it more cheaply. And at the end of the day, it comes down to things like stronger building codes for new development that take account not just of today's risk, but the risk we're going to see into the future. Because unfortunately, given the fact that we didn't rapidly decarbonize, we are locked into growing risk for decades. So it's not as easy as some new standard. It's we have to look out over the life of our buildings and build them for that climate future. And the more difficult challenge is that also means rethinking land use patterns in some places that are just going to become more and more expensive to keep rebuilding. So we're going to have to deal with some relocation as well. So a lot of climate adaptation.
Yeah. Is there anyone that's doing this well and doing it right, that's sort of like seen what's coming and is making the right moves ahead of time?
There are lots of communities that are taking their sort of resiliency investments really seriously. And it's a mix of strong building codes, it's a mix of investing in protective infrastructure, both gray infrastructure like levees, but also lots of green infrastructure, sort of protecting your coastal wetlands to absorb storm surge and these types of measures. And what we're seeing now is sort of the begin, and I should say there's also been a huge rise in federal dollars for these types of investments. So there's now multiple grant programs throughout the federal government to help communities pay for all these investments because it's expensive to do all this. And so what we're seeing now though is the emergence of dialogue between the insurance sector and the models they use to price and underwrite to make sure that those models are capturing all these new local investments. Because unfortunately, we're seeing in a few communities, they've been making these changes and it's not showing up in the market. And so we need to close that loop so that you're getting the feedback from the insurance sector.
Yeah, because it seems to me that the insurance companies have the data. They knew it was no longer profitable to operate inside Florida, and so they left. And the consumers didn't have that same type of visibility. Policymakers may not have had that same visibility.
Yeah.
So it's like it's sharing that data and actually making that risk known and transparent is actually, it could go a huge way.
It's really important, and it's often the case that insurers know a lot more about the disaster risk than the policyholders and the homeowners themselves or the communities. But those are the folks that need to be making the investments in safety. And so, yeah, there has to be much better transparency about these risks.
So what are the chances that this problem, like flood insurance, gets nationalized and lands on the federal government's plate, and all of a sudden there's a national insurance program?
There are proposals for that right now. So we actually already have federal flood insurance, and now there's calls to bring wind and wildfire into that. And EDF is actually working with some researchers on this very question of, should the federal government be stepping into these markets? And if so, what should that look like so that we don't unintentionally create programs with a lot of unintended consequences or perverse incentives? And it's a tricky question, and we're looking actually around the world because there's really nowhere in the developed world that has a completely private insurance market for disasters. Disasters stretch and break some of the kind of fundamental mathematics of risk pooling because everyone gets hit at the same time and it's really bad. And so we've seen governments intervene in various ways. And so we can draw out lessons from what that means for who pays and what are the incentives for risk reduction and these types of things, to rethink what the public sector role is.
I mean, it's declaring a national emergency, which the president can do, the governors can do, and it basically turns on the spigot because it's a black swan event that needs the government to step in. Unfortunately, we're getting more and more of those, and therefore it may need to be something that's a little bit more structured and a little bit more regular. Yes,
exactly. We've treated disasters, like you said, as these kind of one-off emergencies that require special budgeting and special accommodation, but they're going like this, and it's not rare anymore. We know this is just getting worse, and so we need to get ahead of it and plan. And unfortunately, thinking longer term is not something people are very good at and our institutions often aren't designed for. And so we often see a lot of pressure, both for policymakers and the private sector, to do things that might be profitable in the short term but are setting us up for longer term consequences. And some of those are some of the interventions that might make insurance really cheap now, and that seems like a good idea because it's helping the housing market. But if you're just encouraging people to stay in places that are going to have enormous amounts of damage in the future, what's that trade-off look like?
Yeah, and this is also a time, given the state of the housing market and how hard it is for people to afford homes now under the current conditions, is there any political wherewithal to dive in and try and fix this when we're really desperate, we just need more homes built under any conditions?
Yeah, we're at a very tricky moment because like you said, many places desperately need just more housing and more affordable housing. And so we're seeing in many places a lot of pressure to put more housing in areas that we know are unsafe. But that's this kind of short-term, long-term, because in a lot of cases what that is doing is putting our most economically vulnerable households in the position of sustaining future damage that they cannot afford to cover. And unfortunately, we know that disasters hit lower income communities the hardest because they don't have the savings, they don't have the access to credit, they often can't navigate the federal programs, and they can't afford insurance. And so if you don't have any of those financial options to you after a disaster, we can see families actually really fail to recover and kind of unfortunately cycle into really terrible financial circumstance. And so I don't think we really want to be putting people in the position of having to deal with that. Yeah.
I wanted to end on a positive note, but
Okay,
I don't
yes.
think I have one. I don't think that one exists for this problem, but it's good to at least more people know about it, and we can start workshopping. And I'm glad to hear EDF is actually wading into it and trying to help the right policy come out the other side.
Yeah, and there may be an optimism. There are lots of communities that are thinking really hard about how they build resilience and keep their residents thriving in the face of rising risk. So I think there are glimmers of hope out there.
All right,
Great.
nicely done.
Yeah, thank you.
Let's give her a hand, everybody.